Divorce is one of the most financially complex events a person can face. The decisions made during this process can shape the next chapter of a life for decades. Welcome to Advisor in Your Corner, the podcast for individuals navigating the financial realities of divorce in California, and for the attorneys, mediators, therapists, and coaches who support them. Your host is Alex Weinberger, a certified financial planner professional and certified divorce financial analyst. Through his firm, Mirage Financial Solutions, Alex consults directly with clients on the financial side of divorce, and the firm welcomes engagements from listeners and from the professionals who serve them, bringing clarity to the questions that matter the most to you without the jargon. This is Advisor in Your Corner.
Here's a settlement I want you to picture. 2 spouses, a long marriage, a balance sheet that finally, after months of work, ties out to the dollar. He takes the brokerage account. She takes the house. The retirement accounts get split down the middle. Everyone signs. On paper, it's a clean 50-50. Both sides feel like they got half. Then, a year goes by. One of them sells an asset or takes a distribution or simply does the math their accountant should have done at the start. And it turns out the 2 halves were never equal. One spouse walked away with meaningfully more spendable money than the other, and nobody in the room caught it because the spreadsheet balanced. That gap is the subject of today's episode. It doesn't come from anyone hiding anything. It comes from treating a pre-tax dollar and an after-tax dollar as if they're the same dollar. They aren't. And in a high net worth estate, the difference can be the size of a house. So let me tell you where we're going today. I want to cover 5 things. First, why a division that looks equal on the balance sheet so often isn't equal once you account for tax. Second, the basis problem, the single most overlooked number in a property division, and why 2 accounts with the same balance can be worth very different amounts. Third, the assets that quietly carry their own tax bill. The family home and the retirement accounts in particular, because they behave in almost opposite ways. Fourth, why the moment we're in 2026, makes this worth a fresh look. And fifth, how to pressure test a settlement before your client signs it, and the questions worth asking early. I'm not going to hand you tax mechanics to take into a hearing. Your client's tax counsel and the forensic team will run the real numbers for the real facts. What I want to do is help you see the places where an equal-looking deal hides an unequal result, so you know when to slow down and bring that analysis in. Let's start with the core idea. When we divide a marital estate, we're usually working from a schedule of assets and values. The house is worth this. The brokerage account is worth that. The retirement plan has this balance. We add it up, we draw a line down the middle, and we call it equal. The trouble is that the numbers on that schedule are mostly market values or account balances. They are not what each asset is actually worth to the person who ends up holding it. Because at some point, most of these assets get taxed, and they don't all get taxed the same way, at the same rate, or at the same time. $1 of cash in a checking account is already yours. It's been taxed. You can spend all of it. $1 inside a traditional retirement account has never been taxed. When it comes out as ordinary income. So $1 in that account is really worth something less than $1, depending on the rate the holder will pay later. $1 of appreciated stock sits somewhere in between. Part of it is the original investment, already paid for. Part of it is gain that hasn't been taxed yet, and will be when the share is sold. 3 accounts can each show the same balance and be worth 3 different amounts in real spendable terms. If we divide them as if they're interchangeable, we've created an unequal split while believing we did the opposite. The schedule told us we were fair. The schedule was measuring the wrong thing. That brings me to the number I think is the most overlooked in the whole process. Basis. Basis is, roughly, what you paid for an asset, the amount you've already been taxed on. When you sell, you're taxed on the difference between the sale price and your basis. That difference is the gain. High basis, small gain, small tax. Low basis, large gain, large tax. Here's why this matters so much in a long marriage with real wealth. The assets that have been held the longest, the founder's stock, the rental bought in the 90s, the index fund that's quietly compounded for 20 years, are often the ones with the lowest basis and the largest built-in gain. They look the most valuable on the schedule. They can also carry the heaviest latent tax. Now layer in a rule that surprises people. When spouses transfer property between each other as part of a divorce, that transfer generally isn't a taxable event. No one pays tax at the moment the asset changes hands. That sounds like good news, and it is, but it has a tail. The basis goes with the asset. Whoever receives the low basis, stock receives the built-in gain along with it. The tax didn't disappear. It moved quietly to one side of the table. So picture two accounts, purely as an illustration. Each holds $1 million today. One is cash and recently purchased funds with almost no gain. The other is stock bought decades ago, where most of that value is gain. On the schedule, they're identical, $1 million each. In reality, the spouse who takes the low basis stock is holding a future tax bill that the spouse with the cash simply doesn't have. When that stock is eventually sold, a real slice of the million goes to tax. The cash holder keeps the whole million. Divide them straight across and call it even. And you've handed one person a liability the other never carries. The fix isn't hard to understand. You value assets on an after-tax basis when you compare them, or you spread the embedded gain across both sides so neither spouse absorbs it alone. The hard part isn't the concept. It's remembering to ask the question before the schedule gets locked. Let me take the two assets that come up in almost every case, because they behave in almost opposite ways, and both get mishandled. Start with the family home. The home has a feature that almost nothing else in the estate has. There's a federal exclusion that lets an owner shelter a meaningful slice of the gain on a primary residence when they sell. For a married couple filing together, that exclusion is double the size of the exclusion a single person gets. Think about what that means in a divorce. A couple selling the home while still married may shelter up to the larger joint amount. The same spouse selling alone a year or two after the divorce may only have the smaller single exclusion. On a home that's appreciated heavily, and in our market many have, the difference between the joint shelter and the single shelter is real money. The spouse who keeps the house and sells later may face a gain the couple selling together would not have. That isn't a reason to rush a sale or to delay one. It's a reason to know the number before deciding who keeps the house and when it's likely to be sold. Now the retirement accounts, which run the other direction. A traditional pre-tax retirement account is the opposite of cash. Every dollar inside it is still waiting to be taxed as ordinary income when it's withdrawn. So when a settlement splits a retirement account against, say, a brokerage account of the same balance, you're once again comparing a pre-tax dollar to a partly taxed one. They're not the same size. And there's a wrinkle people miss. A Roth account and a traditional account can show the same balance and be worth quite different amounts because the Roth has already been taxed and the traditional hasn't. Two retirement accounts, same number on the statement, different real value. If a deal gives one spouse the Roth and the other the traditional account and calls it even, it may not be. I'll add one more asset to this part because it's common in our client base and it carries a tax most people forget. Rental real estate. When a rental is sold, you don't just face tax on the appreciation. The depreciation that was taken over the years of owning it gets recaptured and taxed too, often at a higher rate than the rest of the gain. So, a rental's after-tax value can be lower than a quick look at its market value and purchase price would suggest. A spouse who takes the portfolio of rentals in exchange for letting the other keep cash may be taking on more latent tax than the schedule shows. None of this means the home is bad, or retirement money is bad, or real estate is bad. It means each asset has a tax character, and an equal division has to account for that character, not just the balance on the statement. Let me put this in the moment we're in because there are a couple of reasons it's worth revisiting right now. The first is simply that asset values have run up. After years of strong markets and a long climb in real estate, the gain baked into long-held assets is larger than it was a decade ago. Bigger gains mean bigger embedded tax, which means the gap between the paper value and the after-tax value is wider than it used to be. The mistake costs more than it once did. The second is the tax environment itself. There was real uncertainty heading into the end of 2025 about whether individual tax rates would jump when the prior law expired. That question has been answered. The federal law passed in the summer of 2025 made the individual income tax rate structure permanent and removed the scheduled sunset. For our purposes, the takeaway is narrow and useful. The rates that determine the cost of these embedded gains are stable and known, not about to reset. So the after-tax analysis you run today rests on firmer ground than it would have a year ago. I want to be careful here. I'm not telling you what rate any particular client will pay. That depends on their income, their other gains, the type of asset, and where they live. And in California, there's a second layer, because the state taxes capital gains as ordinary income, which can add a meaningful amount on top of the federal number. Their tax advisor will pin all of that down. The point is just that the framework is settled enough that running the after-tax numbers is worth doing, because the answer won't shift under you between the negotiation and the signing. So how do you catch this before your client signs? Let me give you the questions I find most useful, the ones that surface the hidden gap early. The first question is simple. For every significant asset on the schedule, what's the basis? Not just the current value. If you only know the value, you only know half of what the asset is worth to whoever takes it. The second, if this asset were sold the day after the divorce, what would be left after tax? You won't sell most of them that day, but the exercise forces the after-tax number into the open, where you can compare like with like. The third, are we matching tax character on each side? Is one spouse taking most of the pre-tax retirement money, while the other takes most of the cash and the residence? If so, the balances might match while the real values don't. The fourth, who is absorbing the built-in gains, and is that on purpose? Sometimes it's a deliberate, sensible trade. One spouse wants the house and accepts the future tax that comes with it. With eyes open, that's fine. What you want to avoid is one spouse absorbing it by accident, because no one priced it. There's a related point worth raising, because it catches people who did everything else right. Even when both sides understand the embedded tax, someone still has to have the cash to pay it when the asset is finally sold. A spouse who ends up asset rich and cash poor, holding the low basis stock or the rentals but very little liquidity, can be forced to sell at an inconvenient moment just to cover the tax bill, and a forced sale is rarely a sale on good terms. So, part of pressure testing a settlement is asking not only who carries the latent tax, but whether that spouse will have the liquidity to absorb it without being pushed into a sale they didn't choose. The after-tax value and the cash flow to support it are two different questions, and both belong in the analysis. And the fifth, which is less a question than a posture. There's no universally right answer to who should take which asset. The spouse who values stability may rationally prefer the home even with its latent gain. The spouse who wants liquidity may prefer cash, even if it means a smaller headline number. The job isn't to steer everyone toward the same answer. It's to make sure both sides see the after-tax picture clearly enough to choose well. This is the place where a financial analyst tends to earn the engagement. Not by replacing the tax advice the client's CPA gives, but by translating a column of pre-tax values into the after-tax reality, so the negotiation happens on real numbers. You'll recognize the cases where it matters most. The long marriage, the concentrated low basis position, the founder's stock, the portfolio of rentals, the estate where the difference between paper and reality is large enough to change what a fair split even looks like. Let me bring this back to where we started. The settlement that ties out to the dollar and still ends up unequal. The reason that happens isn't bad arithmetic. The math is usually fine. It's that the math was run on the wrong number. It was run on the value of the assets, not the value of the assets after tax. And those are different numbers whenever basis, asset type, and timing differ across the estate. In a modest estate, the gap might be small enough to live with. In a high net worth estate with decades of low basis appreciation, it can be large enough to undo everything the division was meant to accomplish. So here's the takeaway I'd leave you with. When a schedule balances perfectly, that's the moment to ask one more question, not to relax. A perfect balance on pre-tax numbers can be the most convincing way to get an unequal result past everyone in the room. The deals that are truly equal are the ones where someone stopped, looked at the basis and the tax character and the timing, and made sure the halves were equal in the only terms that matter to the client, which is what they actually get to keep. If you've got a matter with a big concentrated position, an appreciated home, or a lopsided mix of pre-tax and after-tax assets, that's exactly the kind of case where it's worth bringing the after-tax analysis in early, before the schedule is set rather than after. It's a much easier conversation to have then than to have once everyone has already signed.
Thank you for listening to Advisor in Your Corner. If today's conversation raised questions about your own situation or a client's, Alex Weinberger and the team at Mirage Financial Solutions are available to help. They work directly with individuals navigating divorce and alongside the attorneys, mediators, therapists, and coaches who support them. Every engagement is handled with the discretion, rigor, and independence the moment calls for. To learn more or get in touch, visit marriagefinancial.com. If this podcast has been useful to you, please share it with someone who could benefit and subscribe wherever you listen. This has been Advisor in Your Corner. We'll see you next episode.
The information and opinions presented in this podcast, including the views of guests not affiliated with Mirage Financial Solutions, is for general informational and educational purposes only and should not be considered personalized financial, tax, or legal advice. Mirage Financial Solutions does not provide advice regarding securities or the advisability of investing in securities. Mirage Financial Solutions is affiliated with Weinberger Asset Management, an SEC-registered investment advisor, and may refer listeners to Weinberger Asset Management when investment advisory services are appropriate. However, individuals are not obligated to use the services of Weinberger Asset Management